Welcome to The Explainer. Today we're unpacking a psychological trap that is quietly driving most of the ongoing losses in your portfolio right now. It's this invisible force that completely overrides logic, wrecks risk management, and just drains accounts.
To really get to the bottom of this, let's play a quick mental game. Imagine you're walking down the street, you reach into your pocket, and you realize you just randomly lost a crisp $100 bill. Think about how that physically feels in your gut for a second. Now, contrast that with the feeling of finding a $100 bill on the sidewalk. They're the exact same amount of money, right? But your emotional reaction to them is completely unbalanced.
Well, this phenomenon actually has a name. It's called loss aversion. It's the proven psychological tendency for humans to feel the pain of losing money much more intensely than the pleasure of making that exact same amount. Study after study has proven this emotional asymmetry. We are simply wired to hate losing way more than we love winning.
So losing $100 hurts roughly twice as much as winning $100 feels good. There is a literal 2-to-1 emotional multiplier firing off in your brain. And that multiplier is exactly what hijacks a trading strategy. When you're staring at a red position on your screen, you aren't just reacting to the math, you're reacting to a severely amplified emotional pain response.
Section 1. The coin toss test, a quick mental exercise.
To see how deep this bias really goes, imagine a stranger walks up to you on the street and offers a simple coin toss bet. If the coin lands on heads, you have a 50% chance to win $1,000. But if it lands on tails, you have a 50% chance to lose $1,000. Take a second and ask yourself, honestly, would you accept this bet?
Now, mathematically speaking, the expected value of this bet is exactly 0. From a purely logical, statistical standpoint, it shouldn't really matter if you take this bet or not. It's a wash. Yet, almost all human beings will immediately refuse it. The perceived risk simply feels way too heavy.
Okay, but what if we tilt the odds in your favor? What if we change the rules so you now have a 51% probability to win that $1,000 and only a 49% probability to lose it? Logically, as a trader, this is a bet you should take every single time. Over a large enough sample size, you will make more money than you lose. You have the statistical edge.
But here's the crazy part. Even with a clear, undeniable mathematical advantage, most people still reject the bet. Why? Simply because the thought of randomly losing $1,000 sucks so much more than winning it feels good. That fear of the loss entirely overrides the mathematical reality of the winning edge.
Section 2. The Intel Trap, and why holding losers too long is so devastating.
When this emotional glitch bleeds into financial markets, it creates a massive trap. When a trade goes against us, we fall into a really dangerous hope cycle. You've probably felt this before. You start repeating this phrase to yourself. If only the price can go back. All I want is to get back to where I started. You tell yourself you'll just exit at break-even and be happy. You do this entirely to avoid the agonizing psychological pain of actually realizing a loss. You refuse to take the hit, so you hold on and you hope.
To prove just how uniquely dangerous this mindset is, let's look back at some history. We're going to examine Intel stock right around the massive, historic 2000 dot-com crash. Imagine you were an investor back then. You got hit by FOMO, the fear of missing out, and you bought Intel stock right near the absolute peak, just before the bubble burst. The bottom falls out, your portfolio is bleeding red, but because of pure loss aversion, you stubbornly refuse to sell. The pain of taking that massive loss hurts so much that you convince yourself to adopt a wait-for-break-even strategy. You vow to hold on to Intel until it recovers, and you get your money back.
Well, thinking about the timeline of what actually happened really stretches out the sheer tragedy of that decision. Because Intel did not just bounce back. If you held on hoping for break-even, you wouldn't have just waited a few painful months. You wouldn't have even waited a few years. You would have endured more than 20 agonizing years of waiting just to get your original money back. Intel literally did not recover to those levels until over 2 decades later.
Section 3. The true cost of waiting, also known as opportunity cost. Because the real tragedy wasn't just the stress of waiting 20+ years. It was the devastating opportunity cost of tying up your trading capital in a dead asset. Think about what that money could have been doing. If you had just swallowed your pride, taken the initial loss, and reallocated your capital into the S&P 500, the broader market, you would have experienced massive outperformance. Instead of sitting on dead money, your capital would have been compounding in a major market uptrend for 2 straight decades.
The stark, unforgiving reality here is that being fooled by an emotional pain response trapped capital in a massive hole. Overcoming that bias, accepting a loss, and pivoting to the broader market would have generated substantial returns. The refusal to accept a loss ultimately cost you massive gains.
So this is exactly why recognizing loss aversion is so vital. It is arguably the most expensive cognitive bias in all of trading. It quietly drives your ongoing losses and acts as the root cause for a ton of other dangerous behaviors. Recognizing this bias and choosing to act logically, despite the emotional weight, is what puts you miles ahead of the broader market.
As we wrap up this explainer, I want to leave you with something to really think about. Take a hard, objective look at your own portfolio today. Are you holding a losing trade right now, tying up your valuable capital simply because you're hoping it eventually goes back to break even? I highly encourage you to recognize when your internal emotional biases are overriding your mathematical reality. Because for sure, if you let loss aversion dictate your strategy, it will inevitably cost you money.